Hi, good morning. Uh, I will start with level 2 fixed income. In fixed income, there are two parts. One is the term structure of interest rates and arbitrage fee valuation model. So, these concerned with interest rate dynamics and the, the term structure of interest rates and they are bonds or instruments without embedded options. So these are relatively simple. So I will run through the key concepts. There are two readings, reading 32 and reading 33. Okay. So yeah. Right. Okay. So in this one, the first thing is we need to know about the interest rates. I denote by IR. So we have the spot rates, forward rates, uh, forward rates, and then the swap rates, par rates, and all these things. So let me run through this. Spot rates are the discount rates of a zero coupon treasury bond, government bond. So this is denoted by the symbol R, R1, R2, R3. So this is the discount rate for 1 year of a zero coupon government bond. Similarly, 2 years, 3 years, and forward rates are the rate starting in say 1 year and for a period of 1 year, or is rate starting in 2 years for a period of 1 year, like that. Forward rates. And the swap rates, there is the swap market, which is more liquid, which is basically it is an OTC market, and in some countries where the bond market is not very well developed, the swap market is much bigger. So the swap rates are basically an interest rate swap to hedge the interest rate risk, and swap rate is the fixed leg rate. Is the fixed leg rate in an interest rate swap. The par rates are basically you have bonds trading at par. It means 100 bonds trading at par. Par means 100. Maybe annual coupon paying bonds. So basically, the yield to maturity, if the bond is trading at par, the yield to maturity is the par rate. So these are the fundamentals in interest rates. Now we have formulae how to get the spot rates and forward rates. There is what we call the forward rate model. So suppose you want to know the spot rate for 5 years to the power of 5, 1 plus R5 to the power of 5. You know the term 3 rate. So because it is 3 years to the cube times 1 plus f starting in 3 years for a period of 2 years square. This is the formula where from forward rates we can derive any one rate if we know the other two rates. This is called the forward rate model. This is very important. And the spot rates can be obtained, for example, how to get the spot rates from par curve rates or the par rates using a technique known as bootstrapping. Using a technique known as bootstrapping. So if you have a bond if you have a bond maturing in 3 years, paying 3% per annum annual coupon, so you have like this, like the 100 is the paying at par 100, and this will give coupon for 3 years. Say then each year they pay out 3 plus R1 plus 3 divided by 1 plus R2 square, and the final year the principal also is paid back. So 103, 100 plus 3 divided by 1 plus R3 cube. This is the discounting. Of course, first you need to find one by one. You should start with R1. First you should find R1. So for the 1 year bond, we need to find first R1, then we need to find R2, then we can find R3. This is called bootstrapping. This is how the bootstrapping works. Now let us go to the next topic on the term structure of interest rates. The yield curve. Yield curve. So you have basically the time or term in years, and you have the interest rates. So this is an upward sloping yield curve, yield curve. So maybe this is for 5 years, this is for 10 years, 15 years. So an upward sloping yield curve, like the farther you go into the maturity, the higher the interest rate would be. This is an upward sloping yield curve, and you also have a downward sloping yield curve like this spot curve. So this is 0, this is 5, this is 10, this is 15. So this is the interest rate on the y-axis. So the rates at shorter term are higher than the rates at the longer term. This happens when the economic activity, this is called an inverted yield curve. And the economic activity expected to slow down or contract during a recession, for example, this can happen. There is one more yield curve called a humped yield curve. Like the intermediate rates, maybe this is 5, maybe this is 7, maybe this is 10. The intermediate rates are higher than the short term and the long term. This is called a humped curve. Okay. Now the forward rates, if it is an upward sloping curve, the forward rate will lie above the spot rate, like this. So suppose this is year 2018, this is 2019. So in an upward sloping yield curve, this is the spot curve. This is the spot curve in thick line. and the dash one is the forward curve, is the forward rate, is the forward rate. So upward sloping, please remember the forward rate curve will lie above the spot curve, and the later the initiation, like if it starts later, it will be above the earlier initiated forward curve. So 2020 will be like this. In vice versa, when it comes to the downward sloping, the forward curve will lie below the spot curve. And this is 2018, this is 2019. The later the initiation, the further down the forward rate curve will be below the spot curve. So these are the shapes of the yield curve. Okay, next one. Now there are two things, techniques or strategies. Riding the yield curve. Yield curve I will show it as YC, and rolling down the yield curve. The traders use these strategies to profit from maturities. Now usually there is maturity matching. Like you hold a bond for say 5 years, you hold a bond, okay, you receive the coupons and you receive the principal amount. So you get what is called yield to maturity. So yield to maturity for 5 years is say 6% per annum. Now in writing the yield curve, what you do is, because in an upward sloping environment, so this is the 5 years, say the rate is 6%, and maybe 10-year bond is yielding 8% per annum. So writing the yield curve, because the interest rates are going higher, so you can buy a 8% bond but hold for 6 years. Buy a 10-year bond, 10-year bond at 8% YTM, and then you sell after 5 years, and the expected return, of course, if it is more than greater than 6% per annum, then you have made money using this. Is called the riding the yield curve. So what happens is, when the 5 year when the bond approaches maturity, its value, depending on interest rates, its value may be higher. Suppose it can be, say, a 10-year bond. If it's in the 8th year, it can be at 105, and if you hold for 10 years, to come back to 100. So at 105, maybe you have bought it at 100, so you can make this capital gain, and also whatever income you get, and you can sell it in the 8th year instead of holding till 10. So you're not matching to the maturity. Riding the yield curve in upward sloping curve, buying bonds having maturity longer than investment horizon would provide a total return, that is the coupons and the capital gain, greater than the return on a maturity matching strategy. This is called the riding the yield curve. Now what is rolling down the yield curve? As a bond approaches its maturity, like for example, you have a 5-year bond, then if you look at year 1, year 2, year 3, year 4, when the bond comes to here, year 4, okay, for example, it is valued at lower yield or higher prices. So a bond can be held till it appreciates in price fully. Say for example, you bought it at 98 initially at time 0, and this will become 100. at year 5. Suppose at year 4 it goes to 102. Okay, so you don't wait till the 5th year. You can sell at 102. So there is a $4 gain over 98, and plus the coupon. Say for example, the coupon is 3% per annum. So 3% per annum. This is over a period of 4 years. So this is the total return. This is capital gain plus dividend. Okay, so you can actually make a high return. This is called the rolling down the yield curve. Let's go to the interest rate swaps. As I said, the swap market is more important than the government bond market in certain countries where the government bond market is not deep enough. The swap rate. Okay, so swap is basically an interest rate. Swap is a derivative instrument used to swap from fixed rate. There are two legs: fixed rate and floating rate. So the swap rate is the fixed rate. The swap market is a highly liquid market. It is customizable, and at initiation of swap contracts, no exchange of cash flow occurs. So at initiation in a derivatives contract, no exchange of cash flow occurs. It occurs later at interval, depending on how the interest rates move. So either the fixed rate leg may make money, or the floating rate leg may make money. Now the swap spread is very important. It is the difference between the swap rate, that is the fixed rate leg of a maturity, versus the on the run, that is the latest issued government bond of the same maturity. On the run, not off the run. Off the run means older series. Say for example, what is the 10 years swap rate, swap spread? Okay, then you take the swap rate, okay, for swap rate 10 year, that is fixed, minus the 10 year latest government bond yield. Okay, there are some more rates I will mention here. Z spread. So Z spread TED spread, I spread. So Z spread is basically for the measures the credit risk of corporate bonds. So which is more riskier? Okay. So a bond with a higher credit risk will have a greater Z spread. We have bond 1 is 50 basis points, bond Z spread is 100 basis points, like that. So that indicates the credit risk. So spread is a difference. The TED spread is measures the overall risk perceived in the economy. It is TED spread is LIBOR of a particular maturity minus yield on a T-bill of the same maturity. So it is an indicator of the perceived credit risk in the general economy. Like during the 2008 financial crisis, this spread must have been quite high, whereas when now currently it's low. So this is a measure of a counterparty risk. We also have another one, similar one, LIBOR minus OIS spread. This is overnight interest rate swap. This is OIS interest rate swap in which the period floating rate, in which the floating rate of this swap is equal to the geometric average of an overnight interbank lending rate on every day of the payment period. So this is calculated like the OIS rate. It is not the swap rate, it is the overnight rate. So it is the geometric average. So 1 plus R1, 1 plus R2, 1 plus R90, if it's a 90 days, okay, to the power of 1 by 90 minus 1. This is the geometry. So this also indicates the general risk or the liquidity. Basically, it indicates the liquidity in the market. So it is important for the banks. Okay, liquidity in the market. This is okay. Thank you.